Hello everyone, this is Professor Kent and today's recording is to go over some of the homework at the back of the chapter. The first question that I'm going to do is problem 5.1, and again it's asking you, this is connecting you to the other chapter, and then we are adding one more thing to it, so that will be done at the part A because we're going to show you how your acquisition or differential for the each year from the date of the acquisition to the year end for. So we took over a company. When did we took over a company? We bought in year 2, and now we are in year 4. So 2 years are gone by. So year 2, year 3, year 4 is gone by. Now we are at the end of the year 4, and what is asking you to prepare a schedule. So before we prepare a schedule, we wanted to know what did we do. What we did is we bought 100% of their outstanding shares of Toronto. The total cost that we paid is 226, so that's what the cost of the investment is. So I'm just gonna do it this side maybe. So we have a cost of investment. So we bought, at this point we don't need to worry about it. If you bought less than 100, then we need to worry about it, because then you're gonna have a non-controlling interest. In this case, we bought 100% of it. How much did we pay? We paid 226,000. Then what we needed to do is we bought the company, and we have we know, of course, your asset equal to your liability plus your equity. So this is what the equation was in accounting. That's what we learned. So what we did is we took over 100% of the outstanding shares. So if you took 100% of the outstanding shares, so what we took over the common shares, and we took over the preferred shares. So what we like to do is the carrying amount. So let's look at it, what they're talking about. It could be a multiple choice question. Carrying amount of Toronto's net assets equal to the carrying amount of their equity. That's what I was trying to show you when we was trying to say asset equal liability plus equity. So carrying amount of shareholders equity. So we know the shareholders equity will have my common shares, and we have a retained earning and the equity section, and they're worth 10,000 common shares. My retained earning is worth 80,000. Altogether the company is worth $90,000, but we paid more than what the company is worth, and what we do is we call it, that is your acquisitional differential. Acquisitional differential. When is this happened? It happened differential at when we took over the company. When did we acquired it? It was January 1st. The dates are very important, and it is year 2, and the difference between those two is 136. First we have to allocate to the assets and liabilities, and then the leftover will be a goodwill. In other words, you're calculating the goodwill. So now what we need to know, there is if there's a difference, then we needed to adjust for it. There is no difference here. There is a difference of 2,000 here. It increase, we know that it is increase here. It is also increased by 30,000. Then you going further, you have a liability is same. My debt is different. My debt is gone up by $20,000. And then we also have to read the extra information that is given to us, so that we could see what's happening with our I also forgot the trademarks. When you look at the trademarks, the value of the trademark was 0. It went up to 60,000. So there's another increase in here. So we needed to know when we go to January 1st year 2, because some of the assets are depreciated and some of the liabilities are paid off, or something is happening with it. But before we get there, Let's put it in. What we're going to do is we're going to allocate the difference to our assets and liability first, and the leftover will go to my goodwill, the balance will. First one is my inventory. My inventory increased by $2,000. Then we have a building, which is your net amount, and building is gone up by 30,000. We record them at a fair value, so fair value minus the carrying amount, and this is where we are getting our positives and negatives. So we have assets there increasing. Going further, we have a trademark, and my trademarks were gone up by 60,000, and my liability is also gone up, but my liability is gone, will decrease my it's a liability, it will be a minus, so my long-term debt. And what I'm going to do is I'm going to take a difference of add and subtract. I could have a positive difference or a negative difference. In this case, it is a positive difference. The acquisition differential was 136. From that, 72,000 is allocated to my net assets. And then what we are doing is leftover will be my goodwill. So this is the balance. The balance will called a goodwill. And how much is my goodwill? My goodwill is 64,000. Now they want you to do a schedule for changes. How did we go from year 2 to the end of year 4? That's what we are trying to do. So when you do that, what we have is we start with the balance. So that's what we do, it balance. When it is at the time we took over, that was year 2. The balances was, the inventory was $2,000, building, so you from here you're arriving to this. We have a building was plus $30,000. You have your trademarks, that is 60,000. We have long-term debt, and that is your negative $20,000. And then what we 20,000, and that is my long-term debt. And then we paid more, so we also have a goodwill, and goodwill is tested for impairment. The value of the goodwill is 64,000, and we know that the difference was 136,000, so that's what you're gonna have. Now what happens is that if you started in January, we have year 2, we have year 3, year 4, and then we have ending of year number 4. That's what we have. So year 2, what happens is that if you think about it now, if you have any asset that doesn't depreciate, if you have a positive, it's going to clear by itself. If you have a building, you have a trademark, and you have your then what we, these two assets are, if the asset is amortized, we have to amortize them, or we have to depreciate them. That's what, so this is where this extra information will come from. Now they said the building and the trademark has a useful life of 10 and 15. So building has a 10 and trademark has a 15 years. So if I were to do 30,000 and useful life, we're doing a straight line, and the first is 10 years, so we are going to depreciate the building for 3,000. If I were to think about the land trademarks, they said it's 15 divided 6,000 divided by 60,000 divided by 15. I have to amortize 4,000, so I will have to minus the 3,000 here, minus the 4,000 here. When you have a long-term debt, let's see what the question is asking you to do for the long-term debt, and then we needed to know how long we amortizing the debt. The long-term debt is due on December 31st, the year 6. If they're due on year 6, so how many years is gone? If I were to do that, I needed to I have to pay the value. So what they're asking, they said is the debt due date is year 6. So when did we took over the company? We took over the company in year 2. So year 3, year 4, year 5, year 6. So that's when all the debt will be paid off. So how many years then? So if this will be my year 1, 2, 3, 4, and 5 years. So my debt I will be paid off within 5 years. So how much we're paying each year? Paying each year will be 4,000. So if you're paying it, your debt will go down. How much does it go down? It goes down 4,000 per year. So that's what it goes down by 4 per year. And when you do the depreciation, we have to do the 3,000 per year. And this will be your 4,000 here minus the 4,000. What happens to the goodwill? Goodwill is tested for impairment. And when are we going to do an impairment? Where test is done in year 5. So there's no impairment here, there's no impairment here, but goodwill indicate the value of the goodwill is, they're saying it is 23,000. So if I were to do that, the value is in our books. I'm just going to erase everything here so that we have a less mess on the board. So the value is 64,000 of our goodwill. The value of after the when they did the year end was 23,000. The value of the we test for impairment, and we needed to record a loss. Difference between those two is a loss. It will be recorded in year 4. That will be 41,000. So value of your goodwill will be 20,000. That's 23,000 what they told us. So if I were to do that, I started with a positive number, I have a negative, the value of the inventory is 0. So what are you going to do is, this is your 30,000, take out all these, and then we are left with 48,000. So that's the value of your building is 48,000. If I were to show that, I will show you in a T account. The value of your building was 30,000. Because of my accumulator depreciation, you wrote this. You wrote these 3,000, and when you are going to do this, you have a the value of your building will be 9, so that will be 21,000. So I wrote that wrong. I had something else in my mind. I was thinking of the next one. The next one is same thing. You value will be 48,000. The net, so in other words, this will go through the accumulator depreciation, the cost minus the accumulator depreciation equal to your net book value, and net book value will be your 21,000, and the net book value of your trade will be 48,000. The net book value or the value of your debt will be a negative of $8,000 because we have 2 more years to pay off our debt. We already know the value of your goodwill is 23,000. So when you do that, you have to do an addition here. That's like add, subtract. Then you have to do the same thing. This is negative 3,000. Do add, subtract. What we get is we get a negative of 44,000, and then we have a 84,000. Make sure you're balancing everything right. So now if I were to think about it, if you were to do that, this is one table we showed you how to do that. Now this is the first part, and then the next part is I am going to just use the same information that we have, but we cannot do that. So now this is going back to the chapter number 4. What they did is they took over the company, but we only owned 70% of it before, and what we did is we paid 147,000. So let's look at, I'm just going to erase it because then it gets too much here. So what we did is cost of the investment, we got 70%, but we needed to know the value of 100%. So cost of 70% of the investment is to us is 147,000. This represents 70% of it, and what we needed to do is we needed an implied value of 100%. So how do we get it? 147,000 divided by 70%, and that will give me, the value will be 210,000. So that's what happens. So that's the 10,000. So if I were to do that, if I were to do that, you have to do the same thing. Now we are going to have a change. If the employed value is 210,000, I erased everything, but that's all right. I'm going to leave this here. So that is the value. So the difference between the both, the difference between, 147,000 minus the, I need to calculate, get the calculator to get the number. So 147 minus your 210, and the differential at allocation was 63,000. So that's what we will have, allocation differential at year 2. That's when we purchase it. Then again, what you're going to do is your goodwill is going to be a different amount, and I don't know what the amount is going to be, but we needed to allocate to the assets. So we already allocate, we have an inventory, we are going to do 2,000. That was the allocation. Then we have my building was 30,000. I have those numbers at the bottom. I don't need to work it out. I have a trademarks, and that was my 60,000. I had a long-term debt, and now we are going to get a goodwill, right? So long-term debt, and that is debt. And if I add and subtract, I don't know the number. 2 plus the 30 plus the 60 minus the 20, and that is my 72,000. So what we have is 72,000. So that was my, before we get there, that's the implied value was 210, and I skipped a step in between. We should, before we do that, we needed to see how much the company, we got the employed value, but we have a common shares. We took over their retained earning, and that was 10,000, and we took over the 80,000. And then what happens in this case, the value of the company is 90,000, and the difference between those two is 120,000. We're going to allocate it to the assets first, and then that we did, and the difference between the both will be my goodwill. That goodwill will be my 48,000. So that's 48,000. Now everything is going to stay the same. The only thing is going to change is my goodwill. If my goodwill is changed to, now this is going to be erased. My goodwill here is 48,000. It is tested for impairment, and then everything is exactly the same. So there's no change here, there's no change here. And what happens is to your goodwill, what happened to my goodwill here? They said the goodwill, we need the value of 23,000. A difference between the both, we are going to be test for impairment. If we test for impairment, I take the difference between the both numbers. That will be my 25,000, and I will how did I get the 25,000? The value of your goodwill was 48,000. I need an ending balance of 23,000. I needed to deduct the 25,000, and that's what they're doing. So I add subtract, nothing is changed, but something is changed here, and something is changed at this point. So 3 plus the 4 minus the 4, negative 3 plus negative 4, I don't have a number, plus the 4 minus your 25, I get a number for 20,000. 20,000, and that is a negative number because this is my positive, this is my positive, so that's what we are going to do. So then I get 21,000 plus the 48 minus the 8 plus the 23, I will get 84,000. So that's what I got. But if you look at it, the only thing changes is your goodwill changes when you do that, and that's the only thing changes. So depends on what this cost of the investment is only there so we could calculate the value of our 100% of our company. That's what you're going to do. So that's how the if your implied value is different, that's how we calculate our goodwill. So I am just going to raise one thing here. Sometimes I have a small table, a small screen, so it becomes a little bit harder. So what they're saying is calculate and explain how this change happens. So if they're, you could do a schedule the way I did the schedule, or they're saying it if the simple way to do it, if my employed value is 210,000 from the previous question. The previous question was the value was 226. The value went implied value was down, so the difference was 16,000, which is less. So if it's less than what the cost of the investment, this less will impact my goodwill. How it's going to be impact? My goodwill will be lower by 6,000. If my goodwill is lower by 6,000 and it's 16,000, it is going to impact my impairment amount too. So that's what the impact is. So if you were to explain, this is what you're going to have. If employed value is less, it's going to impact your goodwill. If my goodwill is impacted, your acquisitional difference will also change. So originally it was 64,000, now it's 48,000, so the difference is 16,000, and that difference will be carried at this point and carried here. So I have a lot of arrows going here there, but that's what it means. I'm just going to stop here, and I'm going to record video for each of the questions because it takes a little longer to go through the question. So I'm going to stop here. Thank you so much for subscribing to my channel. Don't forget to like my videos. Your feedback is very important to me. Thank you so much, and take care, and bye for now.